Today on InvestTalk, we look at ways to maximize your Social Security benefits. Then we look at why mega cap tech sold off today. I also answer questions about Dell, Budweiser, Domino's Pizza, and more. And at the end, I discuss the future path of antitrust under the new Trump administration.
This is InvestTalk, independent thinking, shared success.
Now, our main focus point is about the fact that more than half of U.S. workers expect to rely on Social Security benefits when they retire. And that's 53%. Okay, we'll say that. And more than a quarter of non-retired U.S. adults expect to be very reliant on Social Security. Think about that. Very reliant means the vast majority of their income is going to be coming from Social Security. And Americans closer to retirement age are more likely to say they expect to be reliant on Social Security benefits. So it just shows you they're coming to the realization that they haven't done enough. Number 2 and 3, retired baby boomers, that's age 60 to 78, and 56% of non-retired Gen Xers, age 44 to 59, say they expect to be relying on Social Security benefits, along with 48% of millennials and 46% of Gen Zers. So it separates as you get into the younger generations. But what this is showing you is that people are just simply not prepared. And, you know, the trends in savings rates have been poor for years. And it's really about lacking a plan. What's crazy is, you know, they're great tools. We have great financial planning tools for our clients. But there are a lot of ways to set a path and have a plan. And this is highlighting that, is that as they get older, they're starting to realize they haven't done enough to reach their goals. And now they're just reliant on this social safety net. That's what Social Security is. It's a social safety net. And what's even more perplexing about this whole situation is that 73% of non-retired and 71% of retired U.S. adults say they are concerned about Social Security promises that they will run out. And I hear this all the time from clients. I'm worried Social Security is not going to be paid. I think that's the third rail. One of the third rails in politics is touching Social Security. And in fact, Trump's going the other way and saying, hey, maybe we don't tax Social Security benefits at all. And so that is just showing you how much that's unlikely to happen. Nobody's going to want to be pinned on being the one to cut Social Security. And so they will make adjustments. They will potentially mean test it, raise the retirement age. They will raise the cap on Social Security taxes for workers. And these are all things that you only have to move them a little bit to change the calculus in a major way. So what's interesting is that they're probably less correct on this than most things. So that's something we don't think our clients should worry about. But what we do say is you have to maximize Social Security. You have to know based on what your benefits will be at full retirement age versus your spouse's, and when you should take one versus the other, right? For a lot of people, it's, hey, the spouse that earned the least throughout their lives, they typically take that earlier. And then the one that makes the most has the higher benefit. They wait all the way till 70. And then at 70, the other spouse takes spousal benefits. So that's a strategy that is common, but everyone's situation is different. But it's a strategy that is vital to get right. Because I think I told the story a couple weeks ago. We had a new client that took Social Security at 64, him and his wife. And because they didn't have a plan of when they should take it. And there's no going back, right? Once you take it, there's no going back. So you need to get it right. You need to have a plan going in, especially when so many people are going to be heavily reliant on it. So don't just take it without understanding why. Why am I taking this Social Security now? If you can't answer that question, you aren't confident in the why, besides, oh, I'm eligible. It's not a reason why. Okay. Why this age? Why am I doing it at 64? Why am I doing it at 67? Why am I waiting to 70? You should know that. If you don't know that, you need to talk to somebody and answer that question.
Thank you for tuning in.
If you enjoyed this content, please give us a thumbs up and subscribe for more updates. Let's look in today's market performance. It was a down day. S&P was down about 40 basis points. Dow was down 30 basis points. And NASDAQ definitely had the worst day. That was down about 60 basis points. And you're starting to see the rollover of the major tech names. Now, part of this could be likely to be the yen carry trade. The yen was stronger on the day, and you saw major selling in Broadcom, Oracle. We saw Tesla down 1.5%. You had Nvidia down over 1%. Continued its downtrend. That's starting to break its major uptrend that it's been in for a while. So that's where you saw the major weakness today. The rest of the market, fairly mixed. You had some stocks that did well, like Disney, that was up about 2% on the day. So there were some winners, but overall a negative day as we head into the holiday shortened week, or the holiday weekend, shall we say. I know the market is open half day on Friday. You're not going to get a whole lot, to be honest with you. It's very, very light volume. Don't really take anything from that day. There's not really any movement is just basically light volume trading and doesn't really tell you much about trends in the market. So that's where we're at. Like I said, large cap growth certainly had the toughest day, down over 1%, whereas large cap value, that was actually up 0.18% on the day. And a big part of that is the dollar. Like I said, the dollar was weak, and that brought some strength to the commodity space. And so you continue to see gold up. Gold was up on the day, not dramatically, but a little bit, especially in a red day. The GDX, the gold miners were up as well. You had silver down a little bit, but that was the market today. And I continue to think we're going to get a choppy, probably positive close to the end of the year. Let's tackle our first caller question, and it will be John from Missouri, looking at KALC or KALC?
The ticker is KLAC. It's KLA Corp.
Yep. Okay. So I thought. Okay. So this is in the semiconductor equipment business. It's currently in a downtrend, like a lot of the other semiconductor equipment companies. Do you own it, or are you looking to buy it?
I was looking to buy it. I don't own anything currently.
Okay. And what's making you interested in this name?
I just saw that some of the semiconductor names were down right now, and I thought it might be a good time to get them at a low price if they might go up in the future. And I picked up Qualcomm today, and I just got looking at. I just stumbled upon KLA Corp, and I was thinking about possibly swapping it out in my portfolio with Qualcomm. It just seems like a bit of a broader semiconductor stock as it manufactures for semiconductor companies versus one specific industry where Qualcomm, or not one specific, but certain niche that Qualcomm fits into.
Yeah. That does make sense. Now, so KLAC is the largest semiconductor wafer fabrication equipment producer. Okay. And so this is more of a company that builds the machines that will build the actual semiconductors. Does that make sense?
Yes.
And so it's going to build machines that will provide chips for a wide range of industries. So I understand that. The issue here is that the semiconductor space has gone through a long uptrend. And if you go from the COVID, short chip shortage all the way up to the recent hype around AI and its deployment, there's been a lot of positive catalysts. And that has pushed business, certainly. Earnings have gone from 2019, $8.46 to $23.74 last year. Now, that was down from the previous year, 6%. And it's supposed to bounce back in KLAC this year and next year. But those estimate revisions are a bit mixed. And they have a lot of debt. In the history of the semiconductor space are big booms and big busts. Big booms and big busts. And typically what happens is when it first starts with, okay, we have too much capacity in the industry, right? There's too much building of chip factories to keep up with the demand. And then demand starts to slow. And then first you say, okay, we don't need more factories. We'll just stick with what we have. And that will start with the down draft in orders for the chip manufacturers, like KLAC, like an ASML, AMAT, etc. AMAT's Applied Materials. And so all of these names are starting to enter a downtrend. And now you're starting to see the other names follow. So these are the names that actually lead on the downside, and they will actually lead on the upside as well. The problem is that this downtrend just started. If you look at the history of the rallies and the falls in the semiconductor space, you'll see that when there is a downdraft, they fall dramatically. So let's go on KLAC. KLAC has been around for a long time. And if you go back to the last downdraft, they peaked out in 2000. They went from $95 all the way to a low of $15. Okay. And then the other downdraft was in 2014. It went from $83 all the way down to $46, so down about 50% there. So, I think this is a name that is probably just starting its downtrend, along with the rest of the space. Look at ASML, their bookings fell 50%. And so, you just don't want to keep this, you don't want to jump on this trend when the downtrend just started. So I would keep on your watch list because it's a good company, but I think this is too early to jump in. Now let's keep things moving and play another listener question now.
Good morning, Justin and Luke. This is Brad from New Jersey. I'm calling to see what you guys think about Anheuser-Busch. Their symbol BUD. It's been beaten up pretty good. I know it's a globally recognized name and they have business all over the world. I picked them up yesterday at $54 a share. Just wanted to see what you guys thought about that. Looking forward to your answer on the podcast. Thank you. Bye-bye.
All right. Looking at Budweiser, the largest brewer in the world and one of the world's top 5 consumer product companies measured by EBITDA. And it has 6 of the top 10 beer brands by volume, according to Euromonitor. And it distributes a total of 23 different brands with over $1 billion in retail sales. So it's a large brewer, and it has a lot of debt, and that's my issue. They have about $80 billion in net debt in its balance sheet on a $100 billion market cap, and its business is good, but it's not growing. Earnings this year are supposed to be up 10%, but those estimates continue to come down. And last year, earnings were only up 1%. Last quarter, revenues were down 3%. You're seeing people move away from beer and a lot of seltzers. And so that's a shift in consumer demand. And also, if they are drinking beer, a lot of times they're drinking microbrews and local beers. And so just the longer term trends are not in favor of Budweiser. And I don't like companies like that where they have kind of poor secular trends, right? Headwinds and a lot of debt. And over time, what this is the perfect recipe for a value trap. So that's why I would sell it. I would not own Budweiser. I think it is a value trap. It looks cheap, but actually it doesn't even look that cheap, right? Even if it's going to make $3.30 this year, it's an $80 or $54 stock. That's a mid to high. That's a high teen multiple with a lot of debt, with poor secular trends. I just think there's a lot more downside to go. So I would not be owning Budweiser. I'd sell it.
Hello, gentlemen. Great show. I have a question on a couple stocks I bought for the long term. I wanted to be in the small cap arena. So I purchased ALSN, Allison Transmission Holdings. I got it at 97. Do you feel like I can hang on to this thing longer? You think it's ran its course already? I just wanted you to go over the fundamentals on that and see if that's a good long-term play for the small cap. And then also I'm going with Tesla. Since Elon Musk is in the White House, I'm just going that for the next 4 years. I don't know if that's a good, solid company to be in as well, since he's involved with it more. But I really appreciate your input on this. Give me your ideas, and that'd be great to go over that small cap company and see if it's something that I can hang on for long term. Thank you.
All right, looking at Allison Transmissions, this is a name that we've actually owned for a while. It is near a 52-week high, around $118 per share. We bought this a couple of years ago in the 30s or 40s, can't remember exactly, but well before it broke out. And so we saw great value there, and we expected earnings to go up, and we expected to do well, but not this well. We didn't think this was going to be a three-bagger, and it has been. But it's been a name that we've loved to continue to own. It's a bit overbought right now, but it's a great business. And so for everyone else out there, it's about a $10 billion market cap. It's firmly moved into the mid caps. When you're over 10 billion, I think that's clearly the mid cap space. And we like mid caps in general. And it's just very profitable. Return equity around 53%. We love that. And they have very minimal debt, $700 million in free cash flow. So if you're talking about a 7% free cash flow yield, that's very good for a business that it does continue to grow. And they do make fully automatic transmissions for basically heavy duty vehicles, so commercial vehicles mainly. And so that is a business that continues to do very, very well. And so I do think this is a name that you can own for the long term, even though it's been overbought. Maybe could go through a consolidation period. I could see that next year, but this is definitely a more long-term buy and hold, especially because of the quality of and profitability of the business and the clean balance sheet. Okay. Now, when it comes to Tesla, that's another story. That is speculative. It's gone up, obviously, on the Trump victory. But that's one thing you said Elon in the White House. Remember, Elon was not elected to anything. And the Doge is not an official department. It's just an advisory board, really. So, obviously he's going to have his hand in things to a degree, but, it's also two big egos, and we'll see how long kind of the love affair between Trump and Elon lasts. And obviously Trump is not a huge fan of putting a lot of money towards EVs. And so what will that look like for Tesla as well? And then you pile on the valuation. Valuation remains extremely stretched on Tesla. So I see it as a speculative vehicle only. This is not a good investment, but it is, if you want to speculate, just kind of like the DJT, right? It was an investment vehicle to a speculative vehicle to express the potential of a new Trump administration. And obviously that played out, but since the election, that's sold off. So I think that you're going to see something similar with Tesla, where there's expectations of all these things that maybe Elon will help bring to fruition with the administration for Tesla, but that's unlikely to be as robust as the market has now priced in. So Allison, thumbs up. Tesla, not so much. Now I'll get to one of my topics, but first let's play another caller question.
I had a question about a Roth IRA account. When I open it, I put 1,000 in for the first 5 years, each year 1,000. At the end of 5 years, will I be able to pull out the full 5,000 or just that first 1,000 initial, I guess, deposit. So I know you got to wait 5 years. I don't know if the account has to be open 5 years or the money that you had put in, do you have to wait 5 years to pull that out? Hope you understand the question. Thank you.
I do understand the question. And from my understanding, it is the full 5,000. The account just has to be established for over 5 years. And then you can take out the contributions to a Roth at any time, penalty free. Thanks for the call. But let's talk a little bit about China. And China announced a stimulus package back in, what was that, September? I think it was September. Let's see. I think it was late September, if I remember correctly. Try to look at a chart. Yeah, late September. That's right. And it initially went up dramatically over just a short period of time, a couple weeks. And then since then, it's kind of trailed off. And a lot of it has to do with the fact that the stimulus package hasn't been well received. There are a lot of critics, and they're saying a few things. Number one is that this package is too small. And the first is, it's a $1.4 trillion package. It's kind of a lot. But it's mainly restructuring the debt of the country. Taking a lot of that off-balance sheet debt from local governments and putting it on balance sheet to the federal government. And critics would say you're just shuffling chairs on the Titanic. And I think there's an argument to that. But if you start to unpack what they are trying to do, it's something that is less splashy and more structural, trying to lay a foundation for more sustainable growth. And that's probably what I give them the most credit for, is having some restraint, not just doing the easy thing, and trying to focus on creating a sustainable economy. Obviously, relying so heavily on exports and massive amounts of local government debt to build infrastructure and new buildings, et cetera, is not smart. It's a misallocation of capital. And this is a way to try to, in many ways, what we did, they're doing the same things we did with the financial crisis, where we kicked a lot of the debt up to the sovereign level, meaning we bailed out the private corporations. And a lot of that debt, we ran deficits, and a lot of that debt was paid off in the private sector and pushed up to where we are now, which is a lot of federal government debt. And that's kind of what they're doing here. Now, it looks a little different because the excesses of debt were more in, like I said, local governments versus private corporations. Now, This shift gives local governments some breathing room in order to potentially redeploy resources to things like essential services and infrastructure that is needed versus ones that just produce higher GDP. So I think that is smart. And hopefully this will also give rise to more jobs, right? Local governments are now under less fiscal strain and can catch up on, a lot of times there's outstanding balances they haven't been able to pay, jobs that haven't been filled because they don't have the budget, et cetera. So this can free up some of that. And so the market is saying this lacks a lot of punch near term and isn't really giving a boost to economic growth that the administration has always talked about, right? 5% growth, et cetera, consistently. And they're undershooting that picture. And the fact that this is more reshuffling of debt or restructuring of debt and less fiscal stimulus is saying, hey, that goal is less important. I think that is a smart thing. It actually is generally a positive. But what this is telling you is that this is going to be a long-term process. They see what they at least believe they need to do. And they know it's not, take the heroin, right? And juice the economy in the near term. It's let's find a path out of this conundrum that they're in of poor demographics, poor allocation of resources through building way too much real estate, being way too heavily reliant on exports. And let's find a path forward that is more sustainable. Now, that doesn't mean they're going to be successful, but I do think that they have a higher chance of being successful because they are not being so myopic and focusing solely on, GDP growth. So this could make the Chinese economy more durable and resilient over the long term. And that's probably the best thing you can say right now about China, because they do have a lot of problems. And the second best thing is they haven't done a lot that is catastrophic from a geopolitical standpoint. And so something to continue to watch, but it's also a reminder that, hey, don't expect this investing in China is going to be this instant panacea because they're going to do a ton of stimulus. I think it's going to be similar to what you've seen over the past few months. Big surges higher, a while where things kind of fizzle out, and then you get to the next phase of stimulus. And that's going to create a lot of volatility, some opportunity, but also still a lot of risk. Now, I hope you're telling your friends that our podcast is available in video form over on YouTube, and we get questions submitted via the comment section there, and let's tackle one of those questions now. Isaiah Tipton says, can you evaluate Domino's Pizza, DPZ? What do you think of the company? And what would be a good entry point? All right. Let's take a look at Domino's Pizza. This is a name that peaked out. Actually, let me zoom out to a weekly chart. Yeah, this peaked out back in end of 2021. It was in many ways viewed as kind of a growth stock because earnings were rising dramatically from $9.57 during pre-pandemic to a high last year of $14.66. Earnings are supposed to go up another 14% this year, but those estimates continue to come down. In fact, last quarter, revenues are only up 5%, and earnings were actually flat year over year. But if you're looking at the multiple it's trading at, it's trading in the high 20s. Okay, based on backwards looking earnings. Forward looking earnings, you're still mid 20s in P. That's pretty expensive, to be honest with you. And it's still in a downtrend. It hasn't recovered those 2021 highs. And while it's a good business, I like that this is on your watch list. I just can't buy a pizza company at these valuations. Remember, I think it was Kramer that said, oh, Domino's isn't a pizza company, it's a technology company. I always thought that was really funny. But profitability is trending lower, and they do have a decent amount of debt in their balance sheet. Solid free cash flow, but free cash flow yield is about 3%. It's not amazing. So, and it's trading at enterprise value to EBIT around 21, which is not cheap. So I don't like the lack of growth. I don't like the high multiple it's trading at. I do like the business. I just need a much lower price. Now you ask, what price would that be? Get that for you. I'm going to say back down around 285. The 472 now. So I think there's ways to go before this is a reasonable valuation. Thanks for the call.
Learn more about our services and insights by visiting InvestTalk.com.
Hi, this is Dan from Walnut Creek, and I had a question about Dell Technologies. It's up 49% over the past year, but recently it's like over the last 6 months, it's down 35%. It took a big hit, I think, yesterday or the day before. So I was wondering what your thoughts are holding on to this. I have a small position, and I was thinking of keeping it for another year to 3 year range, or if I should just get rid of it at this time, or possibly buy more. Your thoughts would be appreciated. Thanks. Bye.
All right, looking at Dell Technologies, it's had earnings with some other PC makers last night, and this was down dramatically, about 12% on the day. And it is now entering a bit of a downtrend from its high in 2021. This is another, let me pull this up. So if I go to a weekly chart, this peaked at, come on, work for me. There we go. It peaked back in, June at $180 per share, and it fell all the way to 88. Now we're back. Recent high was about 144, and now we're at 124. And earnings next year are expected to be $7.83. So if you're looking from multiple perspective, it's trading out in the high teens multiple. Now, revenues were still good, up 20%. Earnings up 14%. But if you look at some of its other competitors in the space, it is not any more profitable. Okay, it's profitable. Don't get me wrong. Return on invested capital 17%. That's good. Near an all-time high. So I have no issue with that. But I just don't like the valuation that you're paying when you can pay much less for other similar names that also have good free cash flow and good balance sheets, et cetera. So I just don't think it's the best within the space. That's my only issue with it. I think you can find better. And so I would be looking to move on and you have to ask yourself, do you want to still own the hardware business? And, you could argue with the AI cycle that there will continue to be high demand for PCs, laptops, et cetera, servers, and the hardware makers will benefit. And I believe that over the extended period, even though the recent earnings announcements were a bit lackluster. So, yeah, I just think it's not the best maker of PCs that you can find in the marketplace. Thanks for the call. Now, lastly, let's touch on some rumored heads of the Department of Justice or the FTC under the Trump administration. And the one in pole position would be Gail Slater. And this would signify support for a much tougher stance on antitrust. Very similar to current FTC chair, Lina Khan. Now, she is very close with Vice President-elect J.D. Vance. And this could mean major changes coming to the big tech names. In fact, J.D. Vance recently said in the Financial Times that he wants to see Google broken up. So not your typical business-friendly, at least when it comes to tech business, friendly Republican, right? And so she's in pole position. Now, who else could it be? Well, Senator Mike Lee, a Trump ally, and a top Republican in the U.S. Senate, threw his weight behind Mark Meadow, a former enforcer at the Department of Justice and the FTC. So some experience there. But he would maintain also another tough stance on Google, Apple, Meta, Amazon, etc. And I think that is an issue with big tech and by proxy, the broader market, because it's so heavily weighted there. And could that be one of the reasons why big tech is weakening? And it just goes to show you that don't judge this new administration rightly or wrongly, positively or negatively, in the same light as you would a traditional Republican administration. Because there are definitely some outside the box type of nominations, and that from your standard Republican. Now there will be your standard Republican type of nominees, but it certainly be a mix, and you have to judge the direction of policy by these picks, kind of on a one-off basis, because it's going to be very different. Just think of Marco Rubio for our Secretary of State. That's more traditional versus your Tulsi Gabbard's and RFKs. And so I wanted to highlight that because I think there could still be pressure on those mega cap tech names as we head into 2025. I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find at any time at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. And remember, we can help you better understand your portfolio dynamics as we head into 2025 and more appropriately align your strategy with your ultimate goals. We can do that by heading over to InvestTalk.com and clicking on the portfolio review button. And once again, this is a free and confidential service. Now, tomorrow is a market holiday, so we have put together a fresh compilation show. Call it Best of Caller Question Podcast. We'll look for that to be posted on InvestTalk.com and other platforms tomorrow. Independent thinking, shared success. It's InvestTalk. Good night and enjoy your holiday.